best cryptocurrency margin trading guide that you will ever need. If you are into cryptocurrency margin trading, or if you want to find out information about cryptocurrency margin trading or leverage trading, this is the right guide for you. In this episode, we are going to get started. I'm going to explain everything that you need about cryptocurrency margin trading, and in the second episode, I am going to be walking you through Binance futures trading, because Binance is a platform that you are most likely going to be using for all your margin trading needs. So of course, if you guys are going to have like any other extra questions for me, all you have to do is send me an email. I do teach people how to trade. I do teach people the best margin trading practices and just things that you need to look out for, because I have been doing this for a very long period of time. I've been trading professionally for the past 1 year, but investing in cryptocurrencies, I've been doing that since 2016. So on a very professional level, I have been margin trading like on a day-to-day basis for the past 1 year. So I know the ins and the out as far as cryptocurrency margin trading is concerned. So without further ado, let's jump into the first edition, or the first part of this particular tutorial, and we're going to get started with everything that you need to know with cryptocurrency, with regards to cryptocurrency margin trading. So first of all, you have to know that there are different types of margin trading requirements that you are needed, and criteria based on your choice is obviously going to depend on the needs that you're going to obviously be having. So if you've got like several different needs, right, obviously different margin trading platforms are going to provide the solution. So before you even think about margin trading, right, you have to think about what particular platform is going to cater to your needs. Is it going to be Binance? Is it going to be Bybit? So let me just briefly explain, right? So Binance.com is a particular margin trading platform which also has got spot trading as well. But the only advantage of Binance margin trading is there's a lot of different alternative cryptocurrencies, So for example, if we go to BinanceFutures.com, right? I mean, if we look at the types of coins that have been listed, or even let me just show you one of my accounts for tutorials, right? As you can see here, we've got like several different options. So Binance is very good for alternative cryptocurrencies, but if you want to trade, for example, the top 10 cryptocurrencies such as Bitcoin, Litecoin, Ethereum, and Cardano, then you can use some other platform called Bybit.com. And of course, I'm going to leave all the links in the description box below, because there's a lot of scams out there. There's a lot of bad people who are willing to take your money. So check out my referral link. It's obviously going to be on the pinned comment section. So just simply click on that particular link and you guys are going to be able to access Bybit or Binance. You guys are not really going to end up being scammed. So the major difference between Bybit and Binance is due to the fact that Bybit only has a few cryptocurrencies which are listed. So if you really want to trade on Bybit, right, of course you only need to concentrate on a few coins, okay, because here there isn't like a lot of options. There isn't as many options in comparison to Binance, because Binance has got quite a number of them. And if you are really looking to have like like a lot of options, then obviously if you are into trading a lot of different alternative cryptocurrencies, then Binance is obviously going to give you like that variety. So that's the first thing that you need to know before you even think about trading cryptocurrencies with margins, because you have to understand the type of needs that you're going to have. If you're just going to concentrate on BTC and Ethereum, Bybit is a place for you. They have a lot of liquidity. They are very, very advanced in terms of the stop losses, the take profits, the trading stop losses, and all the features that you are going to need in order for you to have like a successful trade. With regards to alternative cryptocurrencies, Binance is your best bet. Okay, so that's obviously point number one, right? And I also talked about the criteria that you can use in order for you to find these different in order for you to select the margin trading platform that you're going to be sticking with. Personally, I usually trade on Binance because I usually trade alternative cryptocurrencies, and Binance has got like a flawless interface. Even though there are some nuances, there are some few limiting factors, like for example, if you want to trade different contracts of the same cryptocurrency, right, you're barely going to do that. But with Bybit, you can do that. For example, you can have different contracts on Bybit for Bitcoin. You can, short and long Bitcoin at the same time, because you can, switch between different contracts. And on Bybit, there is like the USDT pair, and there's also a Bitcoin pair. So it just depends on your needs. I'm not really going to dive deep into that because it's going to be like way too much information, and you guys are going to experience analysis paralysis. So for now, let's just keep it simple. Binance for alternative cryptocurrencies, Bybit for Bitcoin, Ethereum, Litecoin, and these top 10 coins. Okay, so the second thing that you really have to consider when you are thinking about getting serious with cryptocurrency margin trading is obviously getting to understand what type of margin trading you are going to be going with. Is it going to be isolated margin? Is it going to be cross margin? So which margin is the best? When I initially started, right, I was trading on BitMEX, and on BitMEX by default, whenever you log in, right, it's usually on cross margin. It is on 100x. Now this is very dangerous because a lot of newbies, a lot of beginners do not even really know what cross margin trading is, and let alone they don't even know what 100x means, especially when it comes to the dangers of being in that particular trade. So this is one of the reasons why you guys off of the bat, you need to understand what type of margin trading mode is going to be required for your trading experience, because it also depends on the type of risk exposure you are willing to deal with, because all these margin trading modes have got like different risk exposures with regards to using them, if you know what I mean. So isolated margin versus cross margin is something that you really need to understand and fully understand the advantages and the disadvantages, so that you can formulate a very good risk-free trading. Because when it comes to trading, right, it's all about eliminating the risk as much as you can. So let's define what isolated margin is and what cross margin trading is before we go any further. So first of all, you have to understand that isolated margin is the margin balance allocated to an individual position. Isolated margin mode allows traders to manage their risk on their individual positions by restricting the amount of margin allocated to each one. The allocated margin balance for each position can be individually adjusted. If a trader's position is liquidated in isolated margin mode, instead of their entire margin balance, only the isolated margin balance gets liquidated. This right over here is the biggest point that you guys are supposed to be taking home. Okay, so let's say, for example, let me give you a practical example. So this is my margin balance. Your margin balance is basically going to be the whole amount that you have in your derivatives account. So in this particular case, right, in my derivatives account on Binance futures is 1,322. Oh, and by the way, the good thing about Binance futures is, in comparison to the regular exchange, right, you are able to like separate your funds. When it comes to Binance futures, right, you've got like a separate account, and your regular spot exchange Binance account also has got like a separate margin balance as well. So that is also like a very good thing, because in case you are using in case you get liquidated, none of your balance is going to be affected in that spot account that you have where your funds are. So that is something that I really appreciate about Binance futures. So basically 1,322 is my margin balance for my Binance futures accounts. Okay, so let's say, for example, I place a trade on Binance Perpetual. Oh, by the way, before I go on, right, when you select a particular contract that you want to trade, For example, there's different contracts here, right? And as you can see, if I switch over to zilliqa, there's obviously this particular platform here. Do you see what is happening? By default, you are on cross mode. So what you need to do is you definitely need to switch and select what type of mode you are looking for. If you're looking for cross or if you're looking for isolated, okay? So I really want to like give you a definition of isolated margins so that you guys can really get to understand it. So right over here, I have switched to isolated margin and I have a leverage value of 1x. Okay, so if you want to go to 10x, 50x, 30x, it doesn't really matter. It doesn't really matter. You can always adjust it. Okay, so for this for this time, I think I'm just going to put it on 1x. So let's say, for example, I wanted to go long, right? Obviously, going long is just buying basically, right? So if I want to, let's say, purchase zilliqa at 0.1, right? And then I want to buy, let's say, 13,000 contracts of ZIL. This is going to be the cost. So I am going to be spending 130 USD on this particular trade. And look at my margin balance. My margin balance is about 1,322. So if I make this order, right, check this out. If I do that, this is what's going to happen. If you look at my open orders, right, this is basically the position size that I'm going to be filled at, and my margin allocation for this particular trade is going to be 130 USDT, if you know what I mean. So once I get filled, this is going to be my margin balance or my order balance for this particular trade. Okay, so when it comes to isolated margin, right, let's say, for example, I end up being liquidated, right? If I end up being liquidated, I'm only going to lose this amount of money that I'm spending on this particular trade. So the balance which is remaining in my margin account, right, in my margin balance, this 1,192 is basically not really going to get affected. It's not really going to get affected. If I get liquidated, I'm only going to be losing the money that I spent on this particular trade. So if my order is going to get filled here, right, then you guys are going to see my liquidation and all that stuff. So we're not really going to dwell into that because I'm just showing you, but you guys understand what I'm trying to say, right? So if I get liquidated on this particular trade, right, my margin balance remains intact. I'm still going to remain with $1,192. However, if I get liquidated, I'm going to lose that particular balance which was there, because that was the amount. I'm like basically losing, I don't know, that amount of money right there, like 118 or something. That's what I'm going to be losing. I hope my mathematics is not really that bad. 200 and something dollars. That's what I'm going to be losing, and that is as far as isolated margin is concerned. So when you talk about cross margin, right, if you talk about cross margin trading, so let me switch over to cross, because you always have to highlight the type of margin that you're going to be using, because that is obviously going to be determining your risk as well. So let's say we go for the same price, right? The same price. We want to buy zilliqa at 0.01 USDT, and we want to buy 20,000 contracts of ZIL. So the cost is obviously going to be 200 USDT. Okay, so if I place this order, right, boom, it's in my order book, right, and 20,000 USDT is obviously going to be costing me about 200 USDT. So what's really going to happen in case I get filled, right, and I'm wrong and the price goes below my entry? Let's say for example, the price goes to around 0.005, it goes to 5/10 of a penny, then that really means I'm like basically in the negative because I am trying to long. If that happens, and unfortunately if I happen to get liquidated, right, if I happen to get liquidated, right, that really means that my margin balance is going to be depleted. So the difference between isolated and cross margin is, once your trade goes wrong, right, when it comes to cross margin, they end up getting money from your margin balance. Okay, with isolated margin, you sort of isolate your margin funds on that particular trade in comparison to cross margin, which they usually end up to they usually go into your margin balance. So with cross, as soon as I start making loss, right? Let's say for example I make a 200% loss. It means I lost more than 200 USDT that I put into this particular order, right? So if I end up making like a $400 loss, right? So even this margin balance is going to be depleting as well, because these guys are going to be considering my margin balance, and they're going to be getting money from this particular balance that I have. And the more the trade goes wrong, the more I continue losing money, the more my margin balance gets depleted. And when this particular margin balance goes to zero USDT, right? And here you're going to see like a risk factor here. They're going to give you your margin ratio. So if it goes to the red line, then it means that my margin balance is being depleted and I might face liquidation. So I'm not really going to get liquidated here so long there is money in my margin account and there's money in my balance. I've got like margin balance, so I'm going to be good. But as soon as all the money gets depleted because the trade is going wrong, right, and this goes to zero eventually, then I entirely lose my margin balance. So that's the biggest difference between cross and isolated. So if you take a look at this, right, according to this information, so for example, let's just read this. For example, let's say Alice enters a long position in BTC worth 1000 USDT with 10x leverage. She has a margin balance of 2000 USDT, but only wishes to risk a portion of that for an individual position. She sets the isolated margin for a position to 100 USDT. If her position is liquidated, she won't lose more than $100 US. The isolated margin amount can be adjusted for open positions. If a position in an isolated margin mode is close to being liquidated, liquidation can be prevented by allocating additional margin to the balance. But we're not really going to focus on this because I just want you guys to like get this concept. Okay, so if you're using isolated margin, you are not going to lose more than the money that you put for that particular trade on that particular position. You only get to lose a portion of that position and your margin balance remains intact. If you are using cross margin, right? So according to this, another common used margin mode on trading platforms is cross margin. In cross margin mode, the entire margin balance is shared across all open positions to avoid liquidation. If cross margin is enabled, the trader risks losing their entire margin balance along with any open positions in the event of liquidation. Any realized P&L from another position can aid a losing position that is close to being liquidated. So I really hope that you guys understand the major difference between isolated margin and cross margin, because you are going to need to make these decisions in order for you to identify the type of risk that you're going to be encountering and what type of strategy that you're going to be using. Personally, I prefer using isolated margin because the more I use isolated margin, right, the better it is for me, because I'm only going to lose a portion of my margin balance because I'm not going to be trading with everything. So let's say for example on Zilliqa, on this particular cryptocurrency, right, I only open a position worth $200. In case I get liquidated, I only lose $200 and the 1,100 remains in my balance and I can still trade. But if I'm using cross margin trading and let's say for example I don't utilize a stop loss, then the price continues going against my position and the margin just gets shared with whatever margin balance that I have, and the money just keeps on depleting until I get to 0 USDT. So long there is money in your margin balance, right, in your account, right, you're not going to get liquidated. Let's say for example you've got 1 million US dollars in your account, right? So it's going to take like a longer period for you to get liquidated, so you're going to be good like that. Okay, so that's just something that you can get to understand before you place any trade, because this is very important. However, I usually stick to isolated. If I'm very confident about a trade, I usually go for like a 10x. If I'm not very confident, I usually go for either a 2x or a 3x and all that good stuff. So I'm not really going to talk about the levels at this particular moment because I just wanted you guys to understand this particular fact, because I really had a tough time, getting to understand these things. So I just thought of explaining this. So let's get back to our presentation. So I hope I answered all these questions. How to choose the best margin trading platform between Binance and Bybit. It just depends on your preference. Are you an altcoin trader or you stick to Bitcoin? If you stick to Bitcoin, then Bybit is perfect for you. However, Binance also has Bybit, but the thing about Binance is you can only trade one contract. On Bybit, you can trade two contracts. Okay, you can have a long and a short position on a Bitcoin contract because you can use the BTC pair contract and the USDT pair contract on Bybit. With Binance, you're only limited to one contract per cryptocurrency. Okay, I am an altcoin trader. I trade a lot of alternative cryptocurrencies, so I usually stick to Binance. Okay, and the difference between isolated margin and cross margin I already explained. I hope you guys really understand that particular point, and everything is super clear. So please remember, if you really want to be trading on Binance, use the link in the description box below, and you guys are going to go to the legit Binance account. It's my referral account, of course. I'm going to get like a few dollars coming my way if you guys are going to be actively trading, but I don't really care about that. I just want you guys to get the legit link. So the link is going to be on the pinned comment on this particular video. So you can also check it out on my description box as well. In case you've got any other questions for me, please email me at 2019nextapp@gmail.com. This is my email in case you want some tutorials on how to trade, how to improve your trades, and how to be like a very good trader. I have technical analysis, trading explanations on my that we can do like on a private sort of arrangement, and that is obviously very easily arrangeable. So please email me all your questions, queries, in case you've got any other things that you would love me to correct, to rectify. Please do that. So talk to you a little bit later. It's been your boy Muna, aka Beyond 10x. Muna, Muna, aka Beyond 10x, and talk to you a little bit later. Bye.